Over the past 2-3 months, there is a significant slowdown in the consumption sector of the Indian economy, according to various statistics. It is also reflected in the stock prices of sectors such as passenger cars, consumer goods, banks, financial services, and infrastructure. The two key market indices, which is the NIFTY and the SENSEX, peaked on 27th of September and have since shown little momentum, or we can say sideways momentum. A sharp two-day rally, which was a day before the Maharashtra elections, was seen as a lucky break for the FIIs to resume their selling. While each such wave of selling will be countered by some buying, the bullish fervor is missing, at least in these sectors which I'm talking about. The traditional year-end rally is due, especially since the past 2 months were dismal. But there is more intriguing aspect of the market hidden behind the nifty moves. Between 27th September and 29th November, the Nifty is down 8%. However, amazingly enough, both the Nifty and the BSE small cap indices, they were down only 3%. And the Nifty micro cap dropped by a mere 2%. This is unusual. This is showing shift of money from the large to the small caps. In a bull market, smaller companies typically outperform the larger counterparts. But in a downturn, the smaller companies usually bear the brunt of the losses. They outperform in the downturn also, but this time it has been different. Now, what explains this anomaly? Investors are optimistic about smaller companies for a reason. The heroes of India's growth over the past 4 years have been smaller and efficient companies in green energy, electrical equipment, defense, healthcare, hospitals, and diagnostics. A variety of manufacturing sectors, infrastructure, including railways, consumer technologies, retail financial services, and wealth management. The new sunrise sectors, such as electronic manufacturing services, EMS as they call it, recycling, smart metering, data centers, are dominated by small companies. These sectors have suddenly become hot and they are actually not represented in the indices in any significant manner, except partly through one or few companies like L&T, which has been a significantly tepid performer. The Nifty and the Sensex consist of big banks. They are stable but hardly growing. They consist of big consumer companies. Again, they are growing by 3-4% every year. Software companies. A company like Infosys, as great a company like Infosys has doubled in the past 20 years. There are these commodity companies, and some of which from the public sector. All these sectors are struggling against the headwinds of the sluggish demand. Bank credit is not growing because companies are still focused on deleveraging their balance sheets. They are doing their capex, but on a very small leverage. While the higher interest rate cost is squeezing the net interest margins of the banks, the stock market is more than willing to fund any reasonably promising growth story of these companies, making equity capital far more attractive than bank credit. Consumer companies are grappling with weak demand, driven by stagnant income growth among the middle class and below. The last significant cycle was driven by the adoption of technology to manage the challenges posted by COVID, the restrictions on companies, employees, and consumers. It remains uncertain whether the current artificial intelligence boom or bust, whatever it will happen eventually, will it benefit or disrupt the Indian software companies, which are already big in size. Now, please note that the 5-year compounded annual growth CAGR in profit of the largest software company of India, TCS, was just 8%. The only bright spot in the Nifty uh, is the pharmaceutical companies, the contract manufacturing companies, pharma companies. Although they are the fastest growing ones inside the Nifty, but they are comparatively slow outside if you compare the companies outside the Nifty indices. This tells us why index stocks are not a very exciting place for investors. They comprise businesses that are easier to understand and their market liquidity is high. Foreign portfolios are full of them, but they are pale in comparison to smaller companies, which today come from an array of sectors mentioned above. They form the second and far more dynamic market, which is eclipsed by the headlines made by the Nifty behemoths. For example, a small engineering company based in Indore with a market cap of just 4,000 crore exports 65% of its output and has notched up a 54% CAGR growth rate in the net profit over the past 5 years. Similarly, a pharma company which avoided the beaten track of rushing into Western markets and concentrated on South America, it has recorded a CAGR in profit of 42% over 10 years. India's biggest listed EMS company, Electronic Manufacturing Services Company, has recorded a CAGR in profit of 39% in 10 years. Currently, its market cap is in excess of 1 lakh crore. I can give scores of such examples. The contrast between these and the Sensex giants is hidden from plain sight. Will these companies keep growing? Is the question. Often, it is the economic policies of the government that drive the corporate growth. In this case, the policy of the past 4 years has been massive. The government capital spending on infrastructure, defense, railways, and support to local manufacturing through production linked incentives, which is called PLI scheme. These initiatives have had a tremendous effect on the smaller companies which we are talking about. Even a tiny fraction of the 11 lakh crore direct government spending or the spending encouraged by the government policies in the private sector coming in the way of some small companies can propel their business into a whole new trajectory. This is exactly what has happened to companies in green energy, electric transformers, smart metering, water management, railway equipment, etc. There is an interesting corollary to all this. By a curious set of coincidences, most of the non promoter shareholding of these small companies is with the Indian retail investors. Some of them have been plainly lucky to be at the right place at the right time. A small number of young, smart investors have done their homework and due diligence to catch the trend. Only a few of these stocks are in the portfolios of mutual funds. This boom has bypassed the big institutional investors who stayed focused on India's sluggish consumer economy and software stocks. This probably explains why the Nifty falls on FII selling in these days. The small cap and the micro cap indices do not drop much. It is a phenomenon never seen before in India, along with many other wonders of the Indian stock market that we have been witnessing since COVID.